Good afternoon. My name is Arik Sherk. I'm a partner in Thompson Hine's Commercial and Public Finance Practice Group, and I work in our Cincinnati and Dayton offices. I'd like to welcome you to today's webinar. This is the sixth in a series of webinars examining what this shift in presidential power can mean for the country. We believe that new market tax credits, the program for today, will be supported or expanded by President Biden. Before we begin, a few housekeeping items. Today's program is being recorded, and we will send a link to all attendees within 48 hours of today's presentation. If you have any questions during the webinar, feel free to use the question box located in the control panel on the right side of your screen to submit questions. We will answer as many of your questions as we can at the end of the webinar. We will also be offering CLE credit for today's webinar. Please be sure to fill out and return the webinar affirmation form that can be found in the handouts section of the control panel located on the right-hand side of your screen. The form provides instructions as to where to send the completed form. You will need a tracking code, which I'll announce at the end of the program. In the handout panel, you also download a copy of the PPT slides and bios of today's speakers. Again, thank you for your interest, and if you have any questions as we go along, please use the question box. I'm delighted to introduce my colleagues that will be presenting today. Joining me today are Sherman, who resides in our Atlanta office and also practices in our Commercial and Public Finance Practice Group. Also joining me today is Alan Kennard, who resides in our Chicago office and practices in our tax group. We have participated in numerous new markets tax credits, also known as NMTCs, across the country, representing the borrowers, who are the equity recipients and must be qualified active low-income community businesses, QualiCBs. You'll hear a lot of acronyms today. We have rendered tax opinions on behalf of the QualiCBs and have assisted the QualiCBs when the NMTC transactions are unwound. We have also represented banks, community lenders, and other parties in NMTC financings as the indirect or direct leverage lenders in these transactions. We have the capability to incorporate other financing techniques, including tax-exempt bonds, tax increment financings, and governmental loans in NMTC financing transactions. We also have experience with state new market tax credit programs and have guided our QualiCB clients through state determination approval processes. I will start with a short description of the NMTC program, including a discussion of the major participants, the economic benefits of NMTCs, the types of projects that are successful in attracting tax credits, and the role of community development entities in allocating new market tax credits. Alan Kennard will follow with a discussion of the legal requirements for participating in the NMTC program, including a description of the IRS-approved leverage structure and how a NMTC transaction unwinds after the 7-year new market tax credit compliance period so that the borrower receives the benefits of the NMTCs. Sherman will then follow with a discussion of a recent NMTC financing involving one of our clients as the borrower, and he will illustrate how other financing sources are used as part of the capital stack that can be integrated with NMTCs. First, a bit of recent news regarding the NMTC program. The NMTC program was extended through 2025 with a $5 billion annual appropriation as part of the Consolidated Appropriations Act in 2021, signed by President Trump on December 28, 2020. Before the extension, the NMTC program was set to expire at the end of 2020. The NMTC appropriation increased from $3.5 billion per year to $5 billion per year for calendar years 2020 through 2025. Additionally, the legislation permits any unallocated funds less than the $5 billion annual appropriation to be carried forward through 2030 instead of 2025 as under prior law. Now turning to the slides. The NMTC program is to provide access to capital to low-income communities. So the NMTC program focuses on bringing community and economic benefits to low-income communities and targeted populations such as low-income persons, minorities, women, and other populations who lack access to quality jobs and community and consumer goods and services. This is done by allowing NMTCs to be sold to tax credit investors, which receive federal tax credits in an amount equal to 39% of the amount of the NMTC financing, which is known as the Qualified Equity Investment, or QEI. They receive those tax credits over a period of 7 years, and we call that 7-year period the 7-year new market tax credit compliance period. The NMTC program is administered by the Community Development Financial Institutions Fund, which is a division of the United States Treasury Department. The CDFI fund is how it's referred to. However, the CDFI fund does not allocate the tax credits itself. Instead, it allocates the tax credits to private entities that apply annually to the CDFI fund for tax credits, which those entities then allocate to borrowers based upon community benefits that are expected to be achieved from their projects. There are generally 4 fundamental participants in a new markets tax credit financing: an allocatee, which receives allocation of tax credits from the CDFI fund; a qualified community development entity, or CDE, which is an affiliate of the CDE, which is affiliate of the allocatee and is formed by the allocatee for each new market tax credit financing to bring NMTCs to that transaction. Also, there needs to be an investor which purchased the tax credits. Its purchase price provides the program subsidy to the borrower. And finally, at least one leverage lender which utilizes the borrower's other sources of financings in order to provide a leverage loan. Alan Kennard will talk about these participants and how they fit into the IRS approved leverage structure later in today's presentation. In an NMTC financing, the borrower receives at least 2 loans. One is funded through the NMTC structure by the tax credit investors funds and is intended to be forgiven at the end of the 7-year tax credit compliance period. The other loan the forgiven loan generally bears interest at a very low interest rate, generally from 1 to 1.2%. The other loan is what we call the non-forgiven loan and is funded through the NMTC structure from the proceeds of the leverage loan and bears interest at a below market rate as well. However, principal payments are not made or permitted to be made on either loan during the 7-year NMTC compliance period, so each loan is, for at least 7 years, a interest-only loan. The non-forgiven loan will generally be structured as a loan with a maturity of up to 40 years, which can be beyond the useful life of the secured assets, and amortization on that loan will begin after the 7-year new market tax credit compliance period. This slide further illustrates the benefits of an NMTC financing, which include, of course, the forgiven loan and the favorable non-forgiven loan. These loans can provide gap or bridge financing and can be subordinate to existing and subsequent creditors. They also can come with more flexible underwriting criteria and are softer in the sense that foreclosure and enforcement rights are not as strict if there is a default. If applicable, there are also a possibility that state new market tax credits can be possible if a state in which the project is located offers NMTCs, and so you can get a joint subsidy of both federal and state NMTCs for your project. But keep in mind that the principal benefit of new market tax credit program is to help the local community by creating substantial community and economic impacts to residents and to help targeted populations, including low-income persons. In order to obtain new market tax credits for a project, the project needs to be one that is of interest to one or more of the allocatees that you will be applying to for the credits. In addition to more generic types of community benefits that you will need to show will be created by your project, often job creation is the biggest one. There are certain types of projects that are currently more likely to get NMTCs. These projects can be operated by for-profit and nonprofit entities. The hot projects at the moment include manufacturing facilities, healthcare facilities, grocery stores in a food desert, charter and independent schools, qualified mixed-use projects, that is, those mixed-use projects that satisfy the 80-20 test, which Alan will talk about later, community facilities, and renewable energy and recycling facilities. Generally, allocatees will focus on just a few or less of these projects, and often within discrete areas of the country. For example, a CDE in Dayton, Ohio may be focused strictly on supporting projects in the greater Dayton metropolitan area. So when you apply for NMTCs, you will need to find allocatees that allocate new market tax credits to your type of projects and within your location. We can be of help to you in finding allocatees that are a good fit for your project. There are a broad variety of permitted uses that NMTCs can be used for. Of course, for the most part, the NMTCs are used to finance and renovate and construct traditional bricks and mortar projects like those I previously described. However, NMTCs can be used to finance business and nonprofit operations, including the purchasing, refurbishing, retrofitting, or leasing of equipment, and funding working capital, inventory, and staffing. So unlike many other forms of governmental subsidy, it's possible to use NMTCs to finance working capital and operating costs. On the other hand, there are a few things that NMTCs cannot be used to finance. First of all, it is generally not possible to refinance or prepay existing debt using NMTC financing, although there are exceptions to that. There are also a litany of so-called sin businesses, such as gambling facility, racetracks, or businesses, the principal purpose of which is to sell alcohol off premises, that are prohibited. For some reason, we left massage parlors off that list. And finally, a borrower may also not participate in an abusive transaction, that is, any transaction or series of transactions which are contrary to the intent of an NMTC program. This is a general limitation that applies for pretty much any federal tax benefit. In order for the NMTC program to work to bring capital to projects, the NMTCs have to be attractive to tax credit investors. NMTC investors are typically financial institutions and sometimes large corporations, but that is less common. And many banks buy NMTCs in order to fulfill their Community and Reinvestment Act obligations. But the NMTC investors do get a dollar-for-dollar offset against federal income taxes equal to 39% of the NMTC financing, again, the qualified equity investment, or QEI. The price they pay for that, though, is typically less than the dollar-for-dollar benefit they receive. Current market pricing is approximately 72 cents per dollar of tax credit. However, if a project is important and has a high profile in the community, you may be able to get one or more financial institutions to vie for the right to buy those tax credits. And in that case, through competition, the pricing may go up. Pricing for NMTCs came down substantially in 2020 due to the COVID pandemic and the lack of financial institution demand, which had, of course, lower profits and less need to shelter taxes. However, current market pricing is higher and may get better. Like other forms of tax credits, low-income housing tax credits and historic tax credits, for example, an NMTC investor does not receive any direct or indirect ownership in the borrower. Instead, a NMTC investor receives a direct or indirect ownership in the Allocatees affiliate, and such affiliate provides the NMTC financing to the borrower. So it works fairly dramatically different than other forms of tax credits. Alan will illustrate how that works later. This slide provides a little bit more discussion of how the allocation process works. Each year, the CDFI fund, which administers the NMTC program, allocates NMTCs to allocatees, which then allocate the NMTCs to projects through the qualified community development entities they create, the CDEs. Allocatees vie very hard for the right to obtain NMTCs from the CDFI fund, and it's an extremely competitive process. Likewise, borrowers must annually apply and compete for one or more sub-allocations at NMTCs for their project, which is also an extremely competitive project. Allocatees are currently closing on NMTCs allocated from previous years and are preparing their applications to the CDFI for 2021 allocations, which will be awarded mid-year. Those applications will include projects that allocatees have in their pipeline. So for projects that are currently do not have allocations, it is important to be talking to your allocatees right now so that your project can, hopefully, be listed in an allocatees application. This makes it more likely that the allocatee will allocate NMTCs to your project if it gets an award. Also note that allocatees generally do not like to provide all of the NMTCs for a single project, so you'll often need to get allocations from 2 or more allocatees to fully fund your project. At this time, I'm going to turn it over to Alan Kennard, who will follow up with a discussion of the legal requirements and the traditional leveraged loan structure utilized to implement an NMTC financing. Alan, your turn.
Okay, thanks, Eric. There are many statutory and regulatory requirements as well as specific guidance provided by the IRS and the CDFI fund which apply to the program subsidy, whether in the form of the forgiven loan or a smaller non-forgiven loan. First, the project financed or the operations financed must be predominantly located in a low-income census tract or otherwise benefit certain targeted populations. There must also be a gap in available financing. That is, the satisfaction of the so-called but-for test must be satisfied. The borrower must be a qualified active low-income community business. The borrower's trade or business or the nonprofit's purpose and operations must be for a qualified business. Also, the new market tax credit financing proceeds must be used for permitted as opposed to prohibited uses as they are discussed, and there cannot be a recapture event during the compliance period. The first legal requirement is that the borrower of the project finance must be predominantly located in a low-income community on the date of the funding of the financing. We can confirm that any particular borrower or project address is located in a low-income community. However, please note that a low-income community is defined by U.S. Census data as a census tract with a poverty rate of at least 20%, or depending on whether the census tract is located in a metropolitan or non-metropolitan area, satisfaction of the applicable 80% median family income test. This requirement only has to be satisfied on the date of the funding of the new market tax credit financing. So if the census tract subsequently does not qualify, that still does not cause a recapture event. The alternative test to being in a low-income community is if it otherwise benefits targeted populations. This alternative test is rarely used, so I won't go into the specifics, but the PowerPoint keeps it for purposes of record if somebody is thinking about using that. A borrower must show that it cannot otherwise obtain a significant amount of financing, and this can be supported in different scenarios, so that but for the new market tax credit financing, the overall financing will not proceed. The project or operations will be significantly reduced in scope. The project or operations will be substantially delayed. There will be unrealized substantial community and economic impacts to residents in the low-income communities or low-income persons, and or the project or operations would not otherwise be predominantly located in a low-income community. With respect to this last scenario, it must be shown that the new market tax credit financing will result in the borrower's proposed operations or projects being located or relocated to a low-income community as a direct result of receiving the program subsidy as an incentive, when otherwise the project would have remained in a non-low-income community or relocated to a community that is not a low-income community. The borrower must also be a qualified active low-income community business, which is known as a Qualic B. It has to be a corporation, partnership, or limited liability company, or it can be a division of the foregoing or simply a separate group of books and records that are unique to the new market tax credit financing. The borrower must also have a trade or business, or in the case of a nonprofit, any activity that furthers its charitable purpose, which is a qualified business. To be a qualified active low-income community business, there are 5 threshold percentage requirements, which I won't go over in detail, but they are to support that a significant portion of the borrower operations are in fact in the low-income community. So these percentage tests apply to gross income, location of tangible property, where services are performed. During the compliance period, also you can't have more than 5% of your average unadjusted basis of property that are collectible, such as antiques, unless they're otherwise part of your inventory that you're selling to customers. And then second, the one that gets the most scrutiny in these transactions is that less than 5% of the average of the aggregate unadjusted basis of the borrower's property can only be attributable to non-qualified financial property. And this includes cash or cash equivalents or owning debt stock and partnership interests. However, reasonable working capital and construction reserves are permitted above this threshold. And construction and working capital reserves are considered to be reasonable if they're reasonably expected to be expended within 12 months of the. And in the case of construction, to the extent that it's going to be longer than 12 months, there's ways to structure around this so that you can draw down construction proceeds for longer than a year. A qualified business includes any business that's not prohibited by the New Market Tax Credit Program. So this can include, as Arik said, manufacturing, healthcare, grocery, and education facilities, etc. Also, if the borrower is a for-profit business, it must be shown that it is reasonably expected that it will generate revenues within 3 years of the funding. And if it's a nonprofit organization, it must be reasonably expected to engage in an activity that furthers one or more charitable purposes within 3 years of the funding. Each of these reasonable expectation tests are satisfied if they're based on reasonable assumptions, regardless of the actual results going forward. A qualified business, however, does not include residential rental housing unless it's part of a qualified mixed-use project and satisfies the so-called 80-20 test. This test requires that more than 20% of the revenue of the mixed-use project must come from non-residential rents, such as rents from retail, commercial, and nonprofit tenants. Qualified business also does not include farming, and it doesn't include a business that consists predominantly, meaning more than 50%, of the development and holding of intangibles for the purpose of sale or licensing. However, this rule does not prohibit a borrower from developing its own intangibles, such as patents for its own use, such as a manufacturer developing an innovative new process. And finally, a qualified business does not include many of the so-called sin businesses that Arik went over. And these prohibited businesses are similar to those in the federal tax-exempt bond rules, because these aren't the types of businesses that provide the desired community and economic impacts required by the program. If any of these prohibitions are problematic, and generally for any new market tax credit financing, there are lots of ways to structure the deal so that you can basically carve out a piece that does in fact satisfy the legal and underwriting requirements. There are a few recapture events related to new market tax credits. I'm not going to go over them because since 2000, with over 56 billion, and that's billion with a B, there's never been a recapture event, because the deals are carefully underwritten and monitored, and there are cure periods for inadvertent errors in violating any of the legal or underwriting requirements. So here, as you would think, are some of the recapture events. It fails to be a qualified business, qualified active low-income community business, etc. I will highlight prepayment also can cause a recapture event, and that's because the program's intended to have a hands-off view on borrowers, and so this interest only for 7 years is a big part of the program, and so they really prohibit any prepayment because they want to make sure that the borrowers have a 7-year period to become financially sustainable. As important as the legal requirements, the underwriting requirements really are the genesis for this program. And as Arik discussed, each year qualified community development entities known as CDEs apply to the CDFI fund for an allocation award, which is an extremely competitive process. And once a CDE receives an allocation award, it becomes an allocatee. To be competitive, each potential allocatee generally commits to satisfy certain high benchmarks in order to demonstrate that the intent of the program will be maximized over and above the minimum standards required by the CDFI fund, such as targeted and specific types of community and economic impacts and expeditious deployment of its allocation award to borrowers and projects. These high benchmarks result in an allocatee having high underwriting standards relating to borrowers and projects. Therefore, obtaining the new market tax credit financing is also very competitive for borrowers going to allocatees. Some of the most important underwriting requirements include that the project has to be what is known in the industry as shovel ready. They want to be able to deploy their allocations as quickly as possible, and so they want to make sure that there are no conditions precedent that are contingent, so that basically everything is ready to go on day one. Also, borrowers and projects should be located not only in just the legal definition of a low-income community, but also those that are particularly highly distressed. Borrowers should also demonstrate that it will provide or retain substantial community and economic impacts to residents in low-income communities and/or targeted populations, such as low-income persons, minorities, women, and veterans, which can be employees or end users. There should also be strong local support, which can be evidenced by letters of support from local governmental leaders or community stakeholders, or if the project is part of a redevelopment plan. And often it is beneficial to be located in a so-called underserved state, which includes Florida, Georgia, Kansas, Nevada, New Mexico, Tennessee, Texas, Virginia, West Virginia, and Wyoming. These so-called understates are those which have not traditionally benefited from new market tax credit financing compared to other states. And each year this determination changes, so that these states generally can switch from year to year. Also, as I mentioned, the project should be shovel ready, so all sources of financing are otherwise committed or close to being committed. All other conditions are satisfied or close to being satisfied, such as having site controlled zoning approvals, permits, and good title. Then, as we discussed, the for-profit reasonable expectation test or the nonprofit reasonable expectation test should be satisfied, and then substantial community and economic impacts will be timely achieved. It's important to note that once a shortfall in financing is determined or a shortfall could arise, it is critical to get on the radar screens of allocatees who are looking for specific types of borrowers and projects, as well as types and locations of communities in which they are located. So it is kind of the chicken and the egg. So they generally don't want to see you until you're shovel ready, but you should get on their radar screens well in advance so that they have an idea of who you are. New market tax credit financing is more likely to be given to a borrower if it is highly distressed, and this is satisfied either by having at least one of 4 primary distress criteria or at least 2 secondary criteria. So a primary distress criteria includes, for example, a poverty rate of 30% as opposed to the statutory minimum of 20%, or if your unemployment rate is 150% or more of the national average, or having median family income rates below 60% compared to the statutory 80%. Alternatively, if at least 2 secondary distress criteria characterize the census tract, and this can include a poverty rate of 25% compared to the statutory minimum of 20%, or several other secondary distress criteria, such as being located in an enterprise zone or otherwise designated as distressed by a federal, regional, state, or local agency. Some of these secondary distress criteria can only apply to certain types of borrowers and projects. For example, if a borrower is a grocery store, the secondary criteria that would count would be that if it is located in a food desert. And for example, if the borrower is a healthcare facility, a second criteria would be if it is located in a medically underserved area. However, a manufacturing facility being located in a food desert or medically underserved area would not count as a secondary distress criteria. The more highly distressed, the more likely an allocatee and investor will be interested in participating with the financing of the borrower. In fact, last year, allocatees that received allocation awards promised to provide at least 75% of their allocation awards only to highly distressed low-income communities or census tracts with very high unemployment rates. There are many types of substantial community and economic impacts that work with the program. So to the extent the project has direct or indirect full-time and part-time job creation, job retention, or construction jobs, especially if they're accessible to low-income persons or other targeted populations, jobs that provide living wages, healthcare benefits, retirement plans, life insurance, job training, and continuing education, projects that result in consumer and or community goods and services. If the project is leased, then the tenants provide their own impacts to the community, and the borrower may, for example, provide below market lease rates or favorable terms to a nonprofit or minority-owned or women-owned tenant. Set-asides for affordable housing in the case of a mixed-use project, and any other types of community impacts that might be unique, such as green type benefits, or if you're renovating a historic historic building or reducing blight in the area. Borrowers are generally required to execute what's called a community benefits agreement, where they agree to use, quote, commercially reasonable efforts to facilitate and make sure that the impacts that they said were going to result in the community do in fact occur. So it's just a good faith effort, basically. As Arik said, these are good candidates for new market tax crediting. So for example, manufacturing facilities are good candidates because they create significant amount of jobs and provide job training, healthcare facilities, especially if they're in medically underserved areas because they provide healthcare. Grocery stores, especially in food deserts, because they provide critical access to food and healthy foods. Charter and independent schools because they provide education to students, especially if they're members of targeted populations. Qualified mixed-use projects, as I discussed, and community-based services such as museums, cultural centers, libraries, youth centers, and community market venues. And renewable and recycling facilities because of the green elements. It's also important to note that these impacts aren't mutually exclusive. So a manufacturer can create not only job creation, but can satisfy LEED standards, provide perhaps daycare to its employees' children, or healthy foods in a cafeteria to its employees. So basically, the more community and economic impacts, the more likely a borrower will receive new market tax credit financing. The IRS came out with this structure a couple of years after the program came into being in 2000 because the economics of the deal didn't work. And so almost every single new market tax credit financing comes down to this fundamental structure. So this is an example of a $10 million financing. 99% of the financings boil down to this fundamental chart effectively. So first, assume that the CDFI fund, as represented by the red box in the top right of the flow chart, awards a non-monetary $50 million allocation award to the allocatee, which is identified in the purple box under the CDFI fund. Then assume that a borrower, represented by the yellow box at the bottom of the flow chart, has a shortfall of $3.3 million in its available financing, but has $6.7 million of other financing, whether in the form of debt, equity, grants, or whatever. The allocatee then spins off a separate CDE for this $10 million financing, which is represented by the second yellow box. This is a special purpose entity to facilitate the financing for a specific borrower. The remaining $40 million of the allocatee's allocation award will be used for other borrowers and projects and other new market tax credit financings. Now assume the investor, represented by the blue box at the top of the flow chart, agrees to participate in the $2 million financing and agrees to purchase the $3.9 million of tax credits for $3.3 million. Pricing can vary depending on many factors such as market conditions, desirability of the project, and other specific investor criteria, but it's this purchase price that ultimately goes down to the borrower in the form of the forgiven loan. So what the investor does is it makes a $3.3 million capital contribution representing the purchase price down to its wholly owned investment fund, which is also represented by a blue box. Then the borrower's other sources of $6.9 million of financing are used for one or more what are called leverage loans, and the leverage lender is represented by the green box to the left of the flow chart. These funds are provided by one or more leverage loans that will total $6.7 million. The investment fund, using the investor's $3.3 million capital contribution and the $6.7 million of leverage loan, makes a $10 million capital contribution down to the CDE in the purple box in exchange for a 99.99% limited interest in the CDE. And the allocatee retains a 0.1% managing member interest in the CDE. The 10 million suballocation from the allocatee down to the CDE gives the CDE the authorization to designate the investment fund's $10 million capital contribution in the CDE as a qualified equity investment. And it's this qualified equity investment on which the 39% of tax credits are based, giving rise to 3.9 million in this example. 100% of these tax credits are allocated up to the investor because it's the 100% owner of the investment fund. Thus, the investor is paid $3.3 million in exchange for $3.9 million of tax credits, which is a $600,000 undiscounted return, which permits the investor to not require return of its $3.3 million capital contribution to the investment fund, which ultimately results in the forgiven loan going to the borrower below. Notice that $3.9 million of tax credits is based on the 10 million qualified equity investment, as I mentioned, but the investor did not fund the entire $10 million. Thus, the investor is able to, quote, leverage its $3.3 million effective purchase price with the $6.7 million of leverage loans that were identified and secured by the borrower. This is the entire purpose and benefit of the IRS-approved leverage structure. The CDE then uses the $10 million of proceeds of the qualified equity investment to make two loans to the borrower. The first is a $6.7 million senior loan, the terms of which are a blended interest rate of the leverage loans up above, except that the interest can only be interest only during the 7-year compliance period. And then the second loan, which is the forgiven loan and the subsidy and the purpose of the new market tax credit program, is in the form of a $3.3 million forgiven loan. Each of these loans are called qualified low-income community investments. Although they are called qualified low-income community investments, they are in fact debt. There should be no inference or concern that the investor, allocatee, or the CDE takes any ownership in the borrower. Technically, some equity is permitted. However, it's extremely rare because those that are the new market tax credit investors in the industry don't want an equity interest for a variety of reasons. And although beyond the scope of this presentation, it's important to note the borrowers can get credit for up to 3 years of prior qualifying expenditures to use as leverage. This basically treats the financing as occurring over a 3-year period, which results in increasing the size of the overall financing, which results in generating more tax credits, which results in generating a higher purchase dollar amount, which then transfers into a higher forgiven loan. So there's many acronyms I won't go through, but basically what this means, and as a tongue twister, as illustrated in the flow chart, the investment fund makes a QEI in the CDE in exchange for NMTCs, and the CDE uses the QEI proceeds to make qualities to a quality which is located in a LIC and benefits LIPs. So nobody would remember that, but if you go to your first new market tax credit seminar in person, people talk with these acronyms and it can be kind of confusing. And then I'll just briefly go over at the end of the 7-year how this all unwinds. And basically what happens is that there are two sales. So, and after the two sales, the forgiven loan basically becomes an intercompany loan. So you can see that there is an agreement between the new market tax credit investor and the allocatee with an affiliate of the borrower to basically sell their ownership interests in the investment fund and the CDE. So at the end of the day, the borrower affiliate basically is either the direct or indirect owner of those two loans that are down to the borrower. So they become intercompany loans, and the $6.7 million loan can amortize, be paid off, or whatever the terms are after 7 years. And then the $3.3 million forgiven loan becomes an intercompany loan and is effectively forgiven. And with that, I will turn it over. Oh, I'll just mention one more thing. I'm not going to go over this, but this really clearly shows how creative and complex these transactions can be. And so what people do in these transactions is they basically take what the borrower's available sources of financing are, and we're able to basically make it the most efficient uses of capital while increasing the maximum new market tax credit subsidy that goes to the borrower. So these can be very complex, but the result of that complexity is basically an economic benefit to the borrower. And with that, I'll go this to Sherman, and he can go over our Meredian Holdings transaction.
Good afternoon, everyone. This is Sherman Golden in Atlanta. I wanted to give you guys an example of why folks go through this brain surgery. And the reason that they go through it, quite frankly, is because the net proceeds of an NMTC transaction are basically better than debt, and they're better than equity. They're better than debt because the net proceeds, the principal of the net proceeds, does not have to be repaid. They are forgiven through that unwind structure that Alan just went through. And they're better than equity because the proceeds are non-dilutive. You're not giving away an interest in the company to get the money. So you're not having to repay it, and you're not having to give up an equity interest to get it. And that's the primary benefit of this to project sponsors, and why people sort of go through what is admittedly a little bit of mental gymnastics to get these deals done. I'm going to give you guys an example of a company here in Georgia that took great benefit of the new market tax credit program. The company is called Meredian Holdings Group. They are located down in Bainbridge, Georgia. They manufacture a plant-based polymer. It's called a PHH polymer, which is basically used to substitute for the oil in plastic. So basically you sort of concoct a cocktail of PHA polymer into a plastics formula in lieu of the carbon, and that product becomes biodegradable or recyclable. So there's tremendous demand for this, given all of the sort of bad news about plastics and plastic waste, right? So this company, and they did their first new market tax credit transaction in 2012. That netted them $5.59 million. They did a second new market tax credit transaction in September of 2013. That netted them $6.2 million. They did a third transaction in April of 2019, which netted them $2.7 million. And they did their last transaction in November of 2019, which netted them an additional $3.3 million. That's a total of $18 million in change over a 7-year period through the new market tax credit program. Could somebody advance the slide for me? So this is what makes Meredian a good sort of candidate for, leave it right there, a good candidate for new markets, and why they were able to attract allocation and debt to their deals, right? Number one, they're in a highly distressed census tract, and it's primarily because it's rural in Bainbridge. Number two, because they created quite a few permanent, well-paid, relatively speaking, jobs 118 to be exact. Next slide, please. And number three, they had quite a bit of, community impacts. It's a green company, right? There's a tremendous amount of interest in reducing the waste stream, and single-use plastics are a significant part of the waste stream. And their sort of business objective is to reduce the amount of single-use plastics in our everyday lives. So they are partnered with, for example, a lot of retail companies like Chick-fil-A and PepsiCo and Procter and Gamble, right? Which, those companies create a lot of single-use plastics, and a lot of that plastic, goes into the waste stream. Some of it ends up in the oceans, and they're all looking for ways to reduce the environmental impact of their products that they sell. And so there's a tremendous amount of interest in what these guys are doing. Next slide, please. Also important to new markets is community support. There's always to these sort of governmental benefit programs a little bit of a political overlay to make sure that the local community is on board with what you're doing. And so, the fact that they'd already gotten, for example, tax breaks from Decatur County, which is where Bainbridge is located, that helped. The fact that the local elected officials were very supportive of the fact that they were opening what was a shuttered plant. They moved their operations into a facility that had previously closed. And the fact that they were creating 118 jobs was very impactful, and everybody, Chamber of Commerce types, were behind it. Next slide, please. So this is what happened in their deals, right? By way of example, right? The purchase price in a $9 million transaction was $2.8 million. A portion of it went to accounting fees and other professional fees. In these transactions, you always want to budget about 10% of the net proceeds for closing costs, and the balance, about 72% of it, went to the borrower in the net proceeds. And that's a sort of general sort of formula of cost of the transaction and what you're going to net. Next slide, please. So here's the benefit for those guys, right? And this is really the impactful part of this thing, right? So if you recall, I said at the beginning of my presentation that it's better than debt and it's better than equity. Better than debt because you don't have to repay it, and better than equity is because you don't have to give away parts of the company to get it. So that $18 million that went into that company over the 7-year period that they did for NMTC transactions allowed them to go out and borrow from the USDA $40 million in 4 separate transactions, right? So the USDA has a program pursuant to which net new market tax credit proceeds constitute equity for USDA loans. So then that $18 million was for the purposes of USDA owner equity, right? So they don't have to go out and raise third-party equity to get those USDA loans. They also leveraged 2 private fund loans of another $40 million, right? So that's $80 million that they've now brought to the table. And then in December of last year, Danimer went public in a $468 million SPAC transaction. They are now traded, right, under the ticker DNMR. So that's a publicly traded company that in the first 7 years of their existence did 4 new market tax credit transactions to basically, as part of their overall financial strategy, to help them grow. And, everybody eventually got a payday. Next slide, please. So this is just a recap of, what I said initially. This money comes in to fill gaps. That it's during that 7-year compliance period, it's interest only, and the interest is very low. The other loan terms are very favorable. It's really soft subordinate financing, and you're able to leverage it to get other capital without having to give up equity in your company. Next slide, please. So, Thompson Hine, we've got a tremendous amount of experience in this space. Between Arik, myself, and Alan, we've done hundreds of these deals from a legal perspective, both in terms of real estate work, the tax work, the structuring work, so forth and so on. Alan has an accounting background, and so we're just very familiar with and very comfortable with this space. Arik, I'm going to turn it back over to you.
Thank you. At this point, we invite you to provide us with any questions you have. You would use the question box to do so. So please provide us with any questions. While we're waiting for questions, I would point out that not only have we at Thompson Hine done a large number of these transactions, we've done them all throughout the country. And so we don't have a geographic limitation on our ability to do these transactions.
One thing I would like to add is sometimes the questions that we get are, for the 7-year compliance period, what if we want to sell our company or, expand somewhere else? And all of those things are doable. There's, typical lender consent rights, but the program really, once you close, it's a very hands-off, passive transaction where you're literally only paying this interest only for 7 years, generally every quarter. And you just sign a certification that you're still in compliance with the programs, such as, you're not renting out to a massage parlor or things like that. So really, once you've closed, there's really not a lot of tediousness about the transaction.
Hey, Alan, this is Sherk. Why don't you go do a bit of a deeper dive into the 80-20 test? I think a lot of the projects we're working on are mixed use projects, and I think it might be helpful to talk about that a little more.
Sure. So the 80-20 test is a bright line test. So literally, if you're, for whatever reason, you might lose a non-residential tenant and below that 20%, that's a recapture event. And there's really no cure period for that. And so what is used to address that is that typically the investor and the allocatee will require that the test really be a 30-70% test. So you have a little cushion. Generally, the community impacts that they like to see are, any of the businesses that Arik had discussed as tenants, and then generally some kind of affordability to the residential units. And so they can kind of play off with each other. So if you've got particularly great impacts coming out of your non-real estate, then a requirement or a request to have a lot of affordability in the residential units isn't going to be so high. But if you've got, like, for example, office space that really doesn't provide a lot of impacts, then you might be on the hook to provide some more affordability. And that affordability is just for the 7-year compliance period. You can, sell them as condos later or become luxury or whatever. It's just during that 7-year period that you're required to have that affordability element in it. You also, I guess, going into this in a little more detail, is you can't use low-income housing tax credits and new market tax credits to finance the same square foot. So you can certainly have deals that involve low-income housing tax credits and new market tax credits. You just basically have to bifurcate those so that you're not financing the particular square footage but with both new markets and low-income housing tax credits. And the reason for that is that the CDFI fund and the IRS have realized that the low-income housing tax credits have been successful for many years, and really that's the main subsidy for affordable housing. But because mixed use has a variety of impacts, the affordability component and residential can also be good for new market tax credits, for that portion of the financing.
So we do have a question, and that is, does the new NMTC product work well with other financing sources like a bond, tax exempt or taxable? And the answer to that is that almost all of the transactions we work with have one or more integrated financings in the capital stack, and that would include tax exempt bonds or taxable bonds that are used to fund the leveraged loan. So typically in these transactions, the leverage lender is an affiliate of the borrower itself and will borrow money from a third party, either a governmental entity that issues bonds and loans the proceeds to that entity, or a bank that provides what we call a source loan to the leverage lender so it can make the leverage loan. And there is, in the tax exempt bond world, I think most bond counsel have come to the conclusion that it is possible to utilize tax exempt bonds to leverage new market tax credit transactions. We have done so at Thompson Hine, utilizing tax exempt bonds that are issued for 501c3 entities. There'll be an entity which is a 501c3 organization that borrows the money through the issuance of the tax exempt bonds, makes the leverage loan. The funds move their way down through the structure and end up with the borrower, which is typically a supporting organization for the 501c3 primary borrower, and it integrates well into that transaction. A couple of caveats on the integration of other financings. One is that if the financings find their way through, are being used as a source for the leverage loan, the leverage loan is always subject to a standstill for the 7-year tax credit compliance period. So the ability for a source loan lender to be able to effectively recoup its money during the 7-year structure can be subject to that standstill, except unless they have a guarantor or some alternative collateral that's not part of the new market tax credit financing, it can go after during the 7-year compliance period. Also, we typically get into some fairly sophisticated intercreditor arrangements in these transactions when other loan financings are part of the capital stack. Any other questions? Alan, Sherman, anything more you would like to talk about?
No, go ahead, Alan.
Well, I was just gonna say, just to reiterate that, almost always you can take whatever your available financing is, including, the 3-year prior expenditures that I mentioned. Sometimes borrowers can do 100% leverage just using their prior expenditures, so that you get credit for that. And you can, for example, in that $10 million example, if you had $6.7 million of prior qualifying expenditures, you could automatically get that 3.3 million forgiven loan. So that's a very beneficial tool that I would say at least a third of transactions have some portion where they use their prior expenditures. And we've done ones where it's been 100% using the prior expenditures so that there's no new source of capital other than just that forgiven loan.
Right. That's particularly true in manufacturing facilities and companies that have been in operation prior to utilizing the new market tax credits.
Yeah, this is Sherman. And the one thing that I'd like to sort of highlight in closing is we've talked a lot about enterprises in terms of their using this financing tool, but you can also use it for community facilities, and people sort of overlook that, right? So you can do it for like community spaces, libraries, clinics, and we're doing several deals now where colleges and universities are also using them for facilities that are located in low-income census tracts. So, you know, libraries, community meeting facilities, clinics, educational facilities, all of those things can take advantage of this financing option.
Great. Well, very good. We are now at the end of our session. I would like to announce the tracking code for CLE. The tracking code is TH02.23 CLE. I'm going to read that again, TH02.23 CLE. If you have any additional questions about our webinar today, feel free to call or email your current Thompson Hine lawyer. If you're not a current client, you can reach out to one of us, and you should have our contact information available. Thank you so much for participating or attending our presentation today, and hope you had learned something useful. Our next webinar in this series, Transition, a Presidential Change, will be held on Tuesday, March 2nd at 2 p.m. Eastern Standard Time. The webinar will address practical advice for antitrust and privacy compliance. Enjoy the rest of your day and stay well.